Hello, I'm Dan Ridsdale and welcome to Edison TV. Today I'm joined by Greg Smith, Chief Executive Officer of IP Group. IP Group are a UK-based investment company focused on establishing, building and supporting IP-based companies in the fields of clean tech, deep tech and health tech. Greg, many thanks for joining me today.
Very nice to see you, Dan.
And can you start by giving us an overview of the 2024 results? You've made some good progress over the course of the year. Can you give us the key highlights there?
Yeah, I guess sort of things that went well this year, just gone, 2024, were we outperformed on realisations. I think we outperformed sort of market expectations, and we also outperformed a broader market, which has remained challenging for private companies to exit. So we had realisations of about 180 million, which was about 5 times the level that we saw in 2023. So that was very good. I sort of signalled that we were seeing those trends the last time we met for the half-year results. So I was very pleased to see that come through for the full year. That included our record cash exit business called Featurespace, which is a fantastic Cambridge spin-out that we were the original investor in, and we exited that business to Visa during the year. So the majority of the cash proceeds for that, about 120 million, came in December, and there's another 15 million or so to come over the short term. So those realisations enabled us to extend our existing buyback programme. So we've got a very active buyback programme at the moment. So we are probably about halfway through an 80 million programme, which, to put in context, would represent us retiring about 20% of our shares in issue. So a really significant programme, and given the big discount to NAV that our shares trade at, that represents a really compelling long-term opportunity. I mean, I can say it represents a long-term opportunity, and I topped up my own personal position in the group in the recent market turmoil. So sort of two significant positives, I think. The challenge for the year was definitely we saw some downward pressure on the NAV per share, so that was down in the year, and that's the big priority for this year, is to return to NAV per share growth. And the good news is, having sort of come through 2 to 3 years of difficult venture and private markets, although the markets remain still reasonably challenging, and the geopolitical situation and some of the changes that we're seeing coming from across the pond are not necessarily helping risk appetite. The good news is a lot of the portfolio companies are very well positioned for driving positive growth in the short term. And I think, continued theme that we've spoken about, we're just starting to see some pools of long-term capital thinking about, or actually actively making, some initial allocations into the private space. Obviously, that's an area where we have a particularly compelling offer. We work very closely with Host Plus, one of the top 10 superannuation funds in Australia. So we're well positioned to expand that business here in the UK. So we look forward with confidence for the year ahead.
Excellent. And you talked particularly about the realisations you've had. You had a good year for realisations. It looks as if you're expecting that to continue. Particularly, you're targeting 250 million pounds worth of realisations between now, I think, and 2027. Can you talk about that and on what's underpinning your confidence there?
Yeah, I mean, they often say in venture that it's the sort of the easiest thing is to write the check, and the hardest thing is to get it back with a return on it. And so it's one of our core KPIs is to deliver profitable cash on cash realisations, which we were successful in doing in 2024. And that trend's continued to some degree in 2025. So at the date of release of our results in March, we delivered about 25 million of exits year to date. We're not anticipating 25 is going to be as good as 24, probably order of magnitude 50 to 70 million of realisations. There's 1 or 2 potential portfolio companies. There's one actually that has mentioned its intention to list on the New York Stock Exchange. For regulatory reasons, I can't go into too many details other than to mention that Hinge Health has filed its S1. So we'll see how that plays out over the course of the year. And there are a couple of other private businesses. And then Between now and end of 27, there's a really rich pipeline of portfolio opportunities. I think a component of that is going to come from our life sciences portfolio. Again, when we've spoken in the past, I've spoken about the fact that we've got about 10 to 12 companies that are at clinical stage in therapeutic development, and that's quite a nice diversified portfolio. As a shareholder, personally, I think that's quite a nice diversified risk reward. Many of those companies are going to hit their phase 1, phase 2, phase 3, and often that's the point at which there is an opportunity to either exit or license. So we need sort of 1 or 2 of those to come through, good to achieve that. And then there's some deep tech and clean tech companies that are in the mix as well. So yeah, we think we've got reasonably good coverage of that.
Great. And then and looking at your portfolio in a bit more depth, I guess. You talked about the headwinds you've got in the portfolio, but equally your core holdings have made some good progress. Can you talk about that balance there?
Yeah, I mean, I hope that shareholders would give us some credit, I suppose, for tending to try to bake bad news that we think is coming on the valuation side into the NAV sooner rather than later. And we tend to bake the good news in, sort of on the crystallization of transactions. And I think that balance is appropriate for the type of business that we run. I mean, there's been a number of businesses that have faced some valuation challenges for sure. I mean, Oxford Nanopore is unfortunately a great example of that. The business has outperformed its peer set, but performed quite in line with its peer set in terms of share price performance. There were some quite good signs in the results this year, particularly around the growth in the applied markets that they've seen. They announced another big partnership in the last couple of weeks with a subsidiary of Danaher, one of sort of the biggest diagnostics companies in the world. So that's sort of encouraging. And they had a number of partnerships that they announced to add to places like the Mayo Clinic, but also with the NHS and UK Biobank and others. So there's sort of good sort of validation on that front. But I think probably most interestingly, Novo Holdings, the parent company of Novo Nordisk, Edison Institute of Technology, joined people like bioMérieux as strategic investors on the register. And I think that's quite important validation of the opportunity they've got. But the share price has been challenged for sure. So that's definitely an example. A couple on the private portfolio side. First Light Fusion, our fusion business, we took a reasonably significant write down in the value of that. It's still above the cost of our investment, but it's down quite a lot from a couple of years ago. And part of that has been around our quite active involvement. We've got a new CEO in the business, and a little bit like how we work with Ceres Power to change their strategy to be focused around just the fuel cell and the fuel cell stack rather than all the balance of plant. First Light Fusion is now focusing its strategy on delivering targets and amplifiers around targets that really enable anyone who's trying to use inertial confinement methods to generate fusion to amplify their energy by a factor of 5 to 10. And we had a really good technical result in partnership with Sandia Labs in the US just in the last couple of weeks, where they sort of smashed the pressure record on this huge machine. And it just sort of opens up new avenues for materials research. And indeed, First Light will have revenues this year, which, there's not many fusion businesses that have got revenues, but it's something that's on the journey towards the point at which there is widespread availability of fusion power. That's the big goal, and that could be in 10 years, 15 years, 20 years, depending on your view of the fusion market. In the meantime, there's an early revenue opportunity. So that business has seen some impairment, but actually I don't think we've been more excited about the prospects for that business than we are now under Mark's leadership.
Right. Can we turn to capital allocation? Can you give us a refresher in terms of your priorities there versus, supporting your current portfolio, making new investments and returns to shareholders?
Yeah, a quick reminder, one of the things that I've done really over the last 2-3 years since taking over as chief exec is to try to have pools of capital that are best suited to particular stages of company development. We're probably still known a bit as IP Group as being a permanent balance sheet investor. And that's about £1 billion worth of net assets. Most of that's portfolio with some cash, but probably less well known and certainly not baked into the valuation at all is that we manage £500 million of early stage tax advantage capital and a couple of $100 million, particularly for Host Plus, one of the big superannuation funds in Australia, on the sort of venture growth side. I think it's a very big opportunity to grow that venture growth bit. But in terms of sourcing and capital allocation, over the last 6-12 months, we've made a really deliberate effort that actually going forward, the majority of our sourcing, particularly for university spin-outs, will be done through our Part Walk platform. And that was something that enabled us to take a bit of cost out of the business during the year. So there's less direct de novo sourcing onto the balance sheet. And so I think from a sourcing point of view, given our discount to NAV and given the maturing portfolio, more of the capital is on getting our key holdings through to valuation, inflection and exit for cash, and ensuring that we are taking the opportunity for the long-term shareholders to benefit from us buying back shares at a discount. And one of the things we've changed for this 12-month period, and we'll review it at the end of the year, is to use half of all the realisations that we make this year to allocate to our buyback programme. And as I said earlier, we're currently partway through retiring what's likely to be about sort of 20% of our stock. So we actually had a general meeting just this morning to make sure that we had the authorities to be able to continue that buyback programme. So we're using stage appropriate capital, and the balance sheet shareholders capital is primarily on the existing portfolio and on buybacks and other returns to shareholders.
Right. And in terms of the existing portfolio, what is the cash runway of the portfolio at the moment?
This is a disclosure that we've tried to make consistently over the every sort of 6-month period. So in the full year results presentation, you can see on the website, we set out a sort of a wheel of funding requirements for the larger portfolio companies. So if you take companies where our holding is more than £4 million, that makes up about 85%-ish of the portfolio. Only about 20% of that total needs to raise capital during 2025, with the balance either expected to be funded to cash break even. That's about a third of the portfolio, includes businesses like Oxford Nanopore, obviously. And the balance of about 50% needs to be funded either in 2026 or 2027. That profile is sort of slightly better than average. Often it's sort of a third. And I think that reflects the fact that we had some quite big financing rounds in 2024. So yeah, and we're in a position as a result of good realisations last year where we can play our role in those funding rounds. So that'll be for companies like Oxa, First Light Fusion. However, we obviously need to bring other investors in alongside us and working hard to be able to do that.
Right. And then sentiment towards the VC sector, what is that like at the moment? And are you seeing, in terms of the Mansion House Compact, are you seeing any changes? What do you expect to transpire as a result of that initiative?
Yeah, I think long term, my views are unchanged that this is a very important part of making sure that we take advantage of some of our structural benefits in the UK. We're very good at fundamental research. There are some areas that we are internationally competitive in, and I've said it on other occasions. There's a danger we end up becoming the sort of the world science lab, and we don't see the benefits from that commercially and in terms of economy. And so, ensuring that the long-term capital providers, that the government regulators play a part in ensuring the conditions are right, is very important, I think, for the future of not just this industry, but for growth in our economy.
Greg, many thanks for coming in and joining me today.
Thanks for having us. Good to see you.